Management of Wipro joins us now. The stock is down about 6% We have three gentlemen, TK Kurien, the CEO and member of the board, Suresh Senapaty, the executive director and CFO, and Saurabh Govil, the senior vice president and global HR head, join in this morning. Gentlemen, morning to all of you. Kurien, I want to start off with you. You know, the stock actually is down about 6% perhaps because the recovery story for Wipro has not been picking up for many quarters now compared to many of your peers. So everyone has had the same set of problems this time around, be it in terms of wage hikes, the currency, etc. But for Wipro, the dollar revenue growth is just not growing as much as the others are. Can you just give us a sense of whether, or rather when, you are expecting the dollar revenue growth to be at par with many of your peers?
Thank you, Sonia. So maybe I should just kind of step back a little bit and give you a little bit of color on what happens to us. Traditionally, over the past couple of years, if you look at us, we've had a traditionally weak first quarter. So it's always been a situation where in the first quarter, we don't grow top line as much as we should. Our operating margin suffers because of wage hikes, and that's been the story of the past. I think one of the biggest opportunities for us is to make sure that we change the trend going forward. As we speak, we are following the regular model where the first half of the year continues to be a little weaker than the second half. And for us, the only positive which gives us hope that that trajectory will turn going forward is the fact that our deal wins have been pretty decent. So given the fact that we are coming off a series of deal wins which have been strong, we expect that quarter 2, quarter 3, quarter 4, we should have clearly a recovery. That's where we are today.
Okay. What about margins, Kurien? Even over there, you don't compare as well as the competition. What's pressuring margins and what might alleviate them?
A couple of things. If you look at last year to this year, and that's an important data point to look at. Last year, quarter 1, our margins were in the region of about 20%. They've gone up to 22.7%. Okay, so there's been a 2.7% increase. If you look at last year's year-on-year growth in quarter 1, it was roughly about 4.5%, which has now gone up to something like 9.6%. So on a year-on-year basis, we are improving our top-line growth as well as our margin growth. Now, clearly, we have a long ways to cover vis-a-vis competition. But, you know, I'm not that pessimistic about margin because at the end of the day, we've remained in this band. Our view is that towards the latter half of the year, we should be able to improve margins. So to that extent, I see this quarter as the quarter gone by, where there are some things we could have probably done better, some things which have done well. So on balance, I would say not particularly too hassled by quarter 1. I think quarter 2, quarter 3, and quarter 4 are the determining quarters for us.
Okay, so in that case, if growth improves, as you say, you're expecting a dollar revenue guidance, you've given a guidance of between 1.7 and 4%. If you were to come at the higher level, how much would your utilization improve and how much would your margins improve if you were to come at the higher end of your growth guidance?
You know, I wouldn't like to give you specific numbers because the minute I do that, I'm guiding for profits. But let me give you a sense. I think we have enough headspace as far as utilization is concerned. Utilization is not a concern today. And quarter on quarter, we've improved our utilization rates as we've improved our fixed price contracts. Our fixed price contracts, if you look at it, are now lying at 52.6%, which is one of the highest we've ever had. And the minute you have a fixed price project, the flexibility that you have in terms of staffing is significantly higher than you have a pure T&M kind of an engagement. So to that extent, I don't think utilization is of course a lever, but I'm not particularly concerned about utilization as we speak. My bigger concern would be to make sure that we are able to kind of drive productivity ahead of commoditization in terms of rates, especially in the bulk business that we have. I think that's the challenge.
Okay. TK, Suresh and Saurabh, good morning and thanks so much for joining in. This is Reema Tendulkar. TK, first question is to you. The Q2 guidance of 1.7 to 4%, does it include any revenues that you're penciling in from the Atco deal? And if yes, by how much?
No, it does include like any other outsourcing deal. So typically every quarter you win some deals in the previous quarter in this. So it does consider some of the ramp-ups that will happen on the deals that we have announced already in the past. And it does include a component so far as the ATCO deal is concerned. So it's a plus and minus of every aggregate like any other outsourcing deal. So that doesn't, and I can't specifically quantify what is the component there, but we have done our own estimate and tucked it in. It is definitely included in that zone.
Okay. Q2 margins, Q2 will also have some margin headwinds like the residual wage hike plus the onboarding of the infrastructure deals. On account of these two, so X of currency, what will be the margin headwind in Q2?
So clearly we had headwinds last quarter and we will have headwinds carry forward or carry over of the last quarter into this current quarter. We've seen traditionally again, Q3 and Q4 are the quarters where we see an uptick so far as margins are concerned. We experienced the same way last year, and our expectation is, because in quarter one we are still equal to, with the decline in the margin, equal to what we delivered for the whole year last year. And the YOY, it is a margin expansion. Q2, we will have headwinds, but in Q3 and 4 you will see recovery, and perhaps we will be able to hold on to our margins with a positive bias so far as the whole year is concerned.
But can you quantify on account of the 2-month wage hike, what will be the margin impact? Will it be 100 basis points impact, 150 basis points?
Components with respect to the margin increase, variable pay, restricted stock units, and a combination of all that, including a little bit of people headcount increase that we talked about. And therefore, if you see the margin got impacted of about 1.7%, and about 1.5% has been because of wage cost hike increase. So the large part of most part of it has been the wage increase from Q4 to Q1.
Okay. TK, the next question is on ADM, because that has been consistently weak. Even in this quarter, it's down 4.7% in reported dollar currency. Is there anything which gives you a sense that ADM might be turning the quarter and you might be able to post a profitable growth in that particular vertical? And also, if you could tell us, is the pricing pressure still visible in ADM?
So, it's kind of, I think we need to do something about reclassifying ADM the way we define it. So if you look at what we put as ADM does not include all the enterprise applications that we have. It includes our legacy mainframe business and our legacy R&D business. So to that extent, ADM should decline. Maybe we should just rephrase it, because I think what happens is every quarter we get the same question. Now, given the nature of the fact that people are moving out of legacy telecom systems and legacy applications which may lie in their embedded base and moving on to newer systems, that component will continue to decline as we go forward. I don't see a big change there. Traditional ADM, which is real ADM, which lies as part of our business advisory services business, that will continue to grow, but we will have commoditization on both infrastructure management as well as application management. To prevent that, the only way we can manage that commoditization ahead of its time is to make sure that we are able to invest in technologies and in processes to lean out a significant portion of work that we have. So that's the big endeavor right now. So we would be investing a disproportionate sum of money in making sure that we build intellectual property to really take out significant amount of work out of our traditional infrastructure management and application management space.
Okay, Saurabh, your attrition rate stands at 17%, over 1 percentage point above the previous quarter. Well, to be fair, your peers, one of them had even shown 19.5% attrition rate. But the point is, they have also shown a lot of growth, your peers, and you yourself are expecting more growth. So will there be more pressure on retaining workforce? Will we have to pencil in, will investors have to pencil in more attrition simply because there is more growth?
So let me give you a background of what has happened in this quarter as far as attrition is concerned and how we are looking at as we move forward. So this quarter we have given our wage hikes to people and done our promotions and stuff. So very clearly we see that as we move forward, we will see a dip in the attrition. Three things that I want to call out. One is, yes, there is a demand upsurge, so we are seeing a momentum in the market and hence attrition. But very clearly for us, our attrition in the senior levels has remained flat. It's only in the 2 to 5 year category where we are seeing a spike in the attrition. Second is, we went and differentiated our salaries and we gave our increases. For our high performers, very clearly we are seeing that the attrition rates have come down much below the company average rates. So overall, from a managing growth, don't see a challenge. We see that this is getting much more comfortable as we move forward. We have done the right inputs in terms of wage hikes, promotions, RSUs to people. Not a worry as we move forward. We'll work in a very narrow band and move forward.
All right, we've actually run out of time, so we thank you gentlemen for joining us and giving us what Wipro has done this time around, and also, more importantly, what the company will do going ahead. All the best for the quarters to come. That's the word coming in from Wipro. The stock is still down about 6% odd.